Good morning, everybody, and welcome to this socially distanced briefing on our 2020 Fiscal Sustainability Report. Thank you very much indeed for tuning in, and I hope that you'll bear with us through whatever the technology has in store. I'm going to take you through the highlights of the report, and my slides and speaking notes will be on the website once we're done. If you'd like to ask Andy, Charlie and me a question, please use the Q&A feature and we'll try to get to as many as possible, and please give your name and institution. So let me start with some background. As regular viewers will know, our FSRs normally include long-term public finance projections that jump off our most recent medium-term budget forecast, as well as a discussion of the public sector balance sheet, drawing in part on the figures in the latest whole of government accounts. But the coronavirus outbreak necessitates a different approach this year. The March budget forecast is now ancient history. The last 4 months have seen unprecedented fiscal and monetary policy action, and the 2018-19 whole of government accounts have been delayed. So instead, in this FSR, we set out 3 medium-term scenarios for the economy and the public finances, based on different assumptions regarding the pace of the economic recovery and the extent of any lasting scarring of economic potential. We then use these to run simplified long-term projections of the public finances, drawing some conclusions around fiscal sustainability. And we then discuss what the pandemic has meant for the array of fiscal risks that we discussed a year ago in our fiscal risks report. The Chancellor's policy announcements last week were not formally a budget and weren't subject to the scrutiny that we would provide in that event. Alas, we received details of the measures too late to include them in the scenario calculations and to be able to discuss them fully in the main document. But we've set out some provisional thoughts on their potential impact in our press release today, and I'll talk a bit about that this morning. Before getting on to the substance, let me as usual express my thanks to the OBR staff and to our helpers in departments and agencies across Whitehall, particularly so on this occasion, given the difficult circumstances in which everyone has been working and the many other demands they have faced. So let me begin by setting out the basic parameters of our 3 economic scenarios, which were finalised on the 19th of June. We started with the outturn data available at the time, which showed a 25% fall in GDP between February and April. This morning's monthly GDP data show a slightly steeper decline in March than initial estimates suggested, and a slightly smaller pickup in May than we'd assumed, but the big picture is very consistent. As time goes by, there is clearly potential for big revisions to both the peak to trough decline and the subsequent pickup. Our scenarios differ from each other primarily in what they assume about the pace of the recovery and the extent of any scarring. In other words, whether activity returns to the path that we forecast in March or remains permanently below it. These depend on 4 main factors: the course of the pandemic and the development of effective vaccines and treatments, the speed and consistency with which the government can lift its health restrictions, the response of individuals and businesses as it does so, and the effectiveness of the policy response in protecting viable businesses and sustaining employment. The upside, central and downside scenarios have the key features shown on the slide, but these are of course only 3 possibilities of many, and you can't place precise probabilities on them. The upside is probably about as good as one could hope for relative to the March forecast, but the downside is by no means a worst case. And we certainly wouldn't claim that the central scenario is necessarily the most likely of all possible outcomes. This chart gives you a summary picture. Here is our relatively unexciting path for GDP in our March forecast, and here are the 3 scenarios. The upside is pretty similar to the illustrative scenario that we published in April, which for simplicity assumed a rapid V-shaped recovery and no scarring. The central and downside scenarios show slower recoveries and scarring worth 3 and 6% of GDP respectively at the 5-year horizon. As you can see here, viewed on a calendar year basis, the scenarios are broadly in line with the range and average of outside forecasts reported to the Treasury. We can draw similar pictures for consumer spending and business investment, where we assume that in the second quarter of the year they were 27% and 40% below our March forecast respectively. Consumption then moves broadly in line with output, while some of the investment lost this year is recouped in the upside and central scenarios. It's interesting at this point to look at how the shortfalls in GDP in each scenario relative to our March forecast compare to the shortfall in GDP during and after the financial crisis, relative to the Treasury's pre-crisis forecast in March 2008. You can see here that the pandemic has prompted a much larger and swifter decline in GDP than we saw in the financial crisis, but that the shortfall against forecast following that earlier episode continued to increase because the underlying growth rate of the economy was persistently weaker than the Treasury and other forecasters had assumed pre-crisis. Our central and downside scenarios assume a permanent hit to the level of GDP from the pandemic, but not to the underlying growth rate. If that rate were also to slow, then the fiscal outlook would be even more challenging. Now let me turn to the labour market. Relative to the March forecast, we assume that total hours worked in the second quarter were down 29%, with employment down 5%, average hours down 25%, and output per hour worked up 8%. This apparent good news on productivity reflects the disproportionate impact of the lockdown on low productivity sectors, plus the fact that employers have tended to furlough relatively low paid workers more than high paid ones. Looking ahead, the outlook for employment depends in large part on the proportion of furloughed staff who flow into unemployment rather than back into work. We've assumed 10, 15 and 20% in the three scenarios. We also assume that the structural rate of unemployment rises by 1 percentage point in the central scenario and by 2 points in the downside one. This gives us the following profiles for the unemployment rate, although initially some of the increase is likely to be recorded as higher inactivity in the official data. As you can see, the peak rates of unemployment in the different scenarios are roughly 10, 12 and 13%. The subsequent improvement is slower in the central and downside scenarios than in the upside, reflecting the scale of economic restructuring implied. CPI inflation follows the same path in all three scenarios, and it differs from the path in March largely because of energy and oil prices. The common path reflects the fact that we make no explicit judgments about the trajectory of the output gap over the scenario period, other than to assume that it's closed by the 5-year horizon, at which point any remaining budget deficit can therefore be assumed to be structural. The path of RPI inflation does differ across the scenarios, reflecting the impact of developments in the housing market on the housing depreciation and mortgage interest payments components of the index. This chart shows some key housing market variables. On the left, the path of house prices in each scenario broadly reflects the path of labour income. On the right, housing transactions have fallen sharply compared to the March forecast, and we assume that the shortfall is entirely made up within the 5-year period in the upside scenario, but are 4% lower in aggregate in the central scenario and 8% lower in the downside. As we regularly point out, most discussion of outside economic forecasts and scenarios focuses on real GDP. But when forecasting the public finances, we're more interested in the components of nominal income and expenditure. This chart shows the paths of nominal GDP in each scenario. The differences reflect the different paths for real GDP, but aggregate GDP deflator growth is also lower in all three scenarios than in March, so nominal GDP doesn't return to the March forecast path, even in the upside scenario. One useful way to pull together the economic picture is to look at the extent to which different sectors borrow from and lend to each other. The common story across the scenarios is that the public health measures greatly restrict consumption and production, while the fiscal policy measures limit the associated falls in income, especially for households. As a result, there is a very big, but mostly temporary increase in household saving this year, and that's the primary counterpart to the massive rise in the budget deficit. But this doesn't mean that the fiscal support payments to individuals are all being saved. For some households, income may not have fallen very much, if at all, but their opportunities to spend have been greatly curtailed. For others, income may have fallen sharply, perhaps because they've lost their job, so they're forced to run down savings or take on debt to maintain even a lower level of consumption. But the former group dominates overall. Before I turn to the public finances, what difference might last week's announcements by the Chancellor have made to the picture that we've painted here? As you know, the Chancellor announced a package of spending increases and tax cuts designed to support jobs that he said would cost up to £30 billion. In addition, a footnote to one of the tables in the accompanying documentation revealed that the Treasury has signed off on an additional £32.9 billion of spending on public services. We estimate provisionally that the actual cost of the package may be about £51 billion, primarily because some of these spending increases are already in our figures, and the jobs retention bonus is likely to come in under the Treasury's up to £9.4 billion figure. In terms of the economic impact, you cannot straightforwardly add the impact on top of the scenarios because they haven't been built up in our usual pre to post measures way. But using our usual methodologies to give a sense of the possible scale, a net fiscal giveaway worth around 2.5% of GDP might increase output by about 1.5% this year, which would then fade over time. That in turn might boost employment by about 140,000 this year. The temporary cut in VAT will lower inflation and then increase it, which will reprofile some welfare and debt interest spending. And the stamp duty cut might increase transactions this year by about 100,000, with about 3/4 of those simply brought forward from 2021-22. It's not clear how the incentive effects of the various job schemes will affect employment beyond the temporary impact of the boost to demand. Some should be beneficial, but much of the job retention bonus is likely to be claimed for employees who would have been retained anyway. So now let me move from the economic scenarios to their fiscal counterparts and begin with some background. When preparing our budget and spring or autumn forecasts, we normally start with a fiscal forecast based on a pre-measures view of the economy and then add the direct fiscal cost or yield from new measures, plus their indirect cost or yield via their usually relatively modest impact on the economy. But that wouldn't be feasible for these FSR scenarios. It would be impossible to quantify with any precision the economic catastrophe that would have unfolded if the government had made no policy response at all. So in this FSR, we add the direct cost of the policy measures to an underlying fiscal scenario that already includes their economic impact. In doing so, we only incorporate the policy measures taken in response to the virus, ignoring other relatively minor changes since March. We developed the central scenario in a relatively detailed bottom-up way, but then ready reckon the upside and downside scenarios more simply. So I'll focus more on the central scenario. This chart shows you that our estimate for the budget deficit in the current fiscal year has moved from £55 billion in the March budget to £322 billion in our central scenario. Just under half the difference, £125 billion, reflects the lockdown, mostly via lower tax receipts and higher welfare spending, partly offset by lower debt interest spending. While just over half, £142 billion, reflects the fiscal policy response, in particular support for households via the furlough scheme and help for the self-employed. Add on our best guess for last week's package, and that increases borrowing by a further £50 billion this year, and the projected deficit hits £372 billion. If we look at the increase in expected borrowing since March over the central scenario as a whole, you can see that the impact of the policy measures on the budget deficit is very heavily concentrated in the current fiscal year, as most of the support is time limited. But borrowing is still pushed higher in later years because the economy is permanently smaller and tax revenues thus remain depressed relative to March. This fiscal scarring is more limited in the upside scenario and greater in the downside. So how has the outlook for government borrowing evolved over the past 2 or 3 years? It's important to remember that the current crisis follows the post-referendum period in which fiscal policy has already been loosened significantly, reversing some of the consolidation undertaken by the coalition. Back in 2016, the government announced a new fiscal objective to balance the budgets by the mid-2020s. Only one of our forecasts ever showed this within reach, our pre-measures forecast in October 2018. But by then, the objective had in effect already been abandoned in favour of the additional NHS spending announced by Theresa May that summer. Further giveaways followed, including the additional capital spending announced by Rishi Sunak in March. That budget confirmed that the government had abandoned the earlier goal of balancing the budget in favour of running ongoing deficits, a decision that it justified on the grounds that it's likely to remain very cheap for the government to borrow, a judgment we'll come back to. Here you can see the impact of the coronavirus in the central scenario, and with the potential impact of last week's announcements added on. What about the impact of the coronavirus and policy response on net debt? Here we can see the impact of the lockdown, adding to debt thanks largely to its impact on tax receipts and welfare spending. Then we can add the impact of the Bank of England's policy measures, including the new term funding scheme and more QE. And then the impact of the government's policy measures, which increase spending and lower receipts. Net debt is £387 billion higher this year than in March, or £437 billion, including last week's announcements, rising to an increase of around £600 billion by 2024-25, or £651 billion after last week's announcements. Where does all this leave the key fiscal aggregates? This slide shows total expenditure and total receipts as shares of GDP in our March forecast. And here are the scenarios. Receipts fall significantly in cash terms in each scenario, but mostly because the economy is smaller. So the ratio of receipts to GDP doesn't vary a great deal. In contrast, the combination of higher cash spending and a smaller economy pushes the ratio of spending to GDP sharply higher this year, to above 50% in all three scenarios. And it remains higher, notably in the central and downside scenarios, because of the lasting hit to nominal GDP. Subtract receipts from spending, and we can see the same picture for the budget deficit. It spikes to 13, 16 or 21% of GDP this year, each significantly higher than the peak following the financial crisis, which was the previous peacetime record. Including last week's announcements, the rise is to 15, 19 and 23%. By 24-25, the deficit is little changed from March in the upside scenario, but still stands at 4.6% of GDP in the central scenario, implying lasting fiscal damage of 2.4% of GDP since March, and in the downside scenario, the deficit remains at 6.8% of GDP, implying damage of 4.6%. If we look at the scenario paths for public sector debt, we see them moving from less than 80% of GDP in the medium term in March to more than 100% in all but the upside scenario. The lines dip in 2024-25 as the bank's term funding scheme loans are repaid. Excluding the impact of the bank's measures, the ratios are all lower, but we see a shallow upward trend persisting in both the central and downside scenarios. You may nonetheless be surprised that the lines are as flat as they are. As we shall see again in a minute, this is because the size of the budget deficit, excluding debt interest, at which the debt to GDP ratio can be stabilised, has risen since March. Both because the debt ratio has increased, which means that you need to issue more bonds just to keep it at its new higher level, and because the relationship between the interest rates at which the government can borrow and the growth rate of the economy has become more favourable. The outlook for borrowing and debt means that in none of our three scenarios would the government be on course to meet all three of the new fiscal targets that it set itself in March. Extra borrowing means that the current budget is still in deficit in 2022-23 in the central and downside scenarios, while the smaller economy pushes investment spending above 3% of GDP in all three. So let's now move from the medium-term outlook to the longer term. In preparing our long-term public finance projections, we've taken a simpler approach than we normally would in an FSR. As always, the major drivers of the long-term outlook for spending, borrowing and debt are the ageing of the population and non-demographic cost pressures in health and social care. This year, we're also able to take on the new 2018-based population projections from the ONS and our decision in March to adopt the zero net EU migration population projection variant. The new projections reduce the number of children, increase the number of working age adults and reduce the number of older adults. Moving from the principal variant to zero net EU migration then reduces net inward migration by 36,000 a year, with the effect of slower population growth concentrated amongst those of working age. The first step is fiscally favourable, the second is unfavourable and dominates the first. The long-term outlook depends to a considerable degree on the state of the public finances at the end of the medium term, what we call the jumping off point, and that of course has deteriorated as a result of the pandemic. If we had used the March forecast as our jumping off point, as we usually would, then the primary budget deficit, which excludes debt interest spending, would have been 1.1% of GDP in 2024-25. Under the three scenarios, it's 1.6, 3.7 and 5.9% respectively. Barring demographics, that's then locked in over the 50-year projection, helping to drive the path of debt. This chart shows the long-term debt to GDP projection corresponding to the October 2018 pre-measures forecast, in which the government was on course to balance the budget by the jumping-off point. The ratio falls for some time, but eventually rises again as health costs in particular put the primary balance back into deficit, and debt interest spending also rises over time. Move ahead to our March forecast, and the fiscal loosening during the May and Johnson premierships has increased the deficit at the medium-term horizon, therefore pushing the debt to GDP ratio onto a more steeply unsustainable trajectory even before the pandemic took hold. Under each of the coronavirus scenarios, the trajectory is steeper still. In practice, no government could allow net debt to persist for long on these explosive paths, as it would find it hard to refinance its mounting deficits. One way to assess the challenge of restoring sustainability is to ask by how much fiscal policy would need to be tightened each and every decade to ensure that by 2069-70, the debt to GDP ratio was back at 75%, roughly the level that the government seemed to think acceptable at the time of the March budget. On our March forecast, the required tightening would be 1.8% of GDP, or roughly £40 billion in today's terms. In the central scenario, it would be 2.9%, and in the downside, roughly 3.8%. So now let me turn to the risks around the public finances above and beyond the choice of the coronavirus scenario. In the FSR, we discuss these in the same categories that we use in our regular fiscal risks report. Incidentally, the Treasury has today published its formal response to the 2019 fiscal risks report. This weighs in at 4 paragraphs compared to the 140 pages in its response to the 2017 report. Of course, it has other things on its plate for now, but we must hope for a more return to a more substantive response in future. The first category of risks we look at are those related to the macroeconomy and the financial sector. As we've often noted in EFOs as well as our risk reports, that history suggests that there is a roughly 50-50 chance of a recession in any 5-year forecast period. That risk has crystallised with a vengeance over the past few months, and we should always remember that there will be more downturns in future. More than that, it's striking that the UK has been subject to 2 once-in-a-lifetime shocks in a little over a decade. Each has pushed the budget deficit above 10% of GDP, whereas no previous post-war recession pushed it above 7%. Perhaps that's just bad luck, but if very large shocks are going to be more common in future than we have so far assumed, policymakers may need to re-evaluate what constitutes a prudent fiscal policy during normal times to ensure that they have the fiscal space to respond to these blows when they land. In addition to shocks and cycles, there remains a risk around estimates of the long-term growth rate the economy can sustain. This has been highly uncertain ever since the financial crisis, thanks to the productivity puzzle, on top of which is the hard to quantify potential impact of Brexit. We can now add the virus as another source of uncertainty, given the possibility that the new normal will require significant structural change in some sectors. As regards the financial sector, so far this has been the dog that hasn't barked during the pandemic period. In part, that reflects the additional loss-absorbing capacity that regulators have required the banking system to build up. But perhaps more importantly, the government has already taken on a large proportion of the potential risk itself by supporting individuals and businesses who would otherwise have been a source of bad loans. But it would be premature to assume no remaining financial sector risks. The largest risks to future revenues are those that affect the whole economy, as we're seeing right now. But the pandemic will also generate or exacerbate other risks. It seems highly likely that the economy will emerge from this crisis with a different composition of output, expenditure and income than would otherwise have been the case. This could affect the tax to GDP ratio because some activities are taxed more heavily than others. Some tax bases may remain subdued. This happened after the financial crisis, most notably in corporation tax thanks to loss release rules. And losses are likely to be more widespread now than then. There are risks around tax debt, the overall value of tax that initially goes unpaid and then is subsequently repaid. Tax debt has spiked and some firms will go out of business before they can pay it off. And the significant demands on HMC in the current period could also lead to a fall in tax compliance. Spending in 2024-25 is already 2% of GDP higher in the central scenario than in March, excluding debt interest, largely because the economy is smaller rather than because of any new policy decisions. But the pandemic may create several additional sources of pressure on public spending. Having experienced the current health crisis, the government may well face pressure to devote a higher share of GDP to the NHS and wider care services, including adult social care, where proposals for reform have been pushed back repeatedly. Health and welfare costs may also increase if chronic health conditions become more widespread, for example, as a result of higher unemployment or the coronavirus itself. Some temporary measures to support individuals and businesses could become permanent if the government wishes to avoid creating some politically sensitive cash losers. For example, around 7 million families will be hit when the £20 a week boost to universal credit and working tax credits is withdrawn next April. And there are many other individual spending risks either created or exacerbated by the crisis. Among them, pressures on local authorities that central government may feel it has to ease. In addition to revenue and spending, there are risks that could affect the public sector's balance sheet, both statistically and in the real world. The government has taken on significant contingent liabilities. Back in March, it trumpeted £330 billion of new loan guarantees, but the eventual cost will depend on take-up and the proportion of the loans guaranteed that go bad. We've assumed a £20 billion cost in the central scenario and £39 billion in the downside. This would be a bigger hit than following the financial crisis, largely because more of today's guarantees have been offered to smaller firms for whom default rates are typically higher. The bounce-back loans look particularly risky since the government has provided lenders with a 100% guarantee and has sought to make them as easy to access as possible. In addition to explicit guarantees, the crisis has of course reminded us that in practice the government stands behind large parts of the economy, implicitly if not explicitly, should they get into financial trouble. And there is always the possibility that private sector entities end up on the public sector balance sheet, either through nationalisation or because the government exerts sufficient control over them for the ONS to reclassify them. Universities are a good example of entities already close to the public-private boundary. Finally, let me turn to the constellation of risks related to the cost and financing of the government's borrowing and of its existing stock of debt and some of the policy choices that it'll have to make in that regard. This chart shows the amount of money that the government would have to raise from gilt auctions and other sources to finance its new borrowing and the redemption of existing debt based on our March budget forecast. As you can see, its financing requirements were already much greater than they were prior to the financial crisis as a share of GDP, reflecting the need to roll over the debt that it took on as a result of that crisis and the subsequent recession. The pandemic and the current policy response have pushed the figure much higher still. In our central scenario, the government would need to raise around £1.4 trillion over the next 5 years, or 12% of cumulative GDP. Despite the Debt Management Office having to ramp up its gilt auction programme dramatically, the government has so far had little difficulty borrowing large sums at very low interest rates. Borrowing costs have been low for some time, of course, not just in the UK but globally, and both gilt rates and bank rate have fallen further since the pandemic took hold. The government's immediate financing challenge has also been eased by the expansion of the Bank of England's quantitative easing programme. Indeed, net of redemptions, the bank is planning to buy roughly the same amount in gilts over the rest of this year as the DMO is likely to need to issue. Bond investors can see that the current spike in borrowing is largely temporary and well justified. And crucially, they have confidence in the robustness of the UK's economic institutions and policy framework. QE may be easing the government's current financing constraints, but the bank is undertaking it of its own free will, consistent with its inflation target. This is a long way from it being forced into direct monetary financing of sustained budget deficits. Indeed, the government has not yet even had to draw on its Ways and Means overdraft facility. This will come as some comfort to the Chancellor as he considers what fiscal targets to put in place as we emerge from the worst of the coronavirus crisis and its economic and fiscal impact. Back in March, he signalled that he was content for the debt to GDP ratio to remain pretty flat, given how cheap it was for the government to borrow. It would be tempting to say the same again, not least because the government would now be able to run a bigger primary deficit while doing so. This chart shows that the debt-stabilising primary deficit at the 5-year horizon was about 1.5% of GDP at budget time, but that doubles in our central scenario, partly because borrowing costs have fallen again, and partly because debt would be stabilised at a higher level and more bonds need to be issued just to keep it there. Put another way, favourable financing conditions not only mean that more can be borrowed without debt rising, they also mean that more must be borrowed to stop it falling, if that's what you wish to achieve. Such a strategy would not be without risk. For one thing, the public finances are much more vulnerable to inflation and interest rate surprises than they were. Not only is the stock of debt going to be much higher under any of our 3 scenarios than appeared likely in March, but the effective maturity of that stock has been reduced yet again by more QE, which in effect refinances gilts at bank rate. Borrowing costs have surprised us time and again on the downside, but the rise in public and private debt globally might suggest a greater risk that the natural rate of interest could rise. In any event, a prudent government will look not just at what it could get away with under current financing conditions, but also at what it might need to do in less favourable ones. So let me conclude. The coronavirus has dealt an unprecedentedly large and abrupt shock to the public finances, both because of the lockdown and the necessary policy response. The big uncertainty looking forward is how much of the resulting economic and fiscal damage turns out to be permanent rather than temporary. One silver lining to the current fiscal cloud is that it remains relatively cheap for the government to borrow, and indeed it has become more so. But that could lull policymakers into a full sense of security. In addition to its long-standing priorities for public services and capital spending, the pandemic may put additional upward pressure on spending and downward pressure on receipts. And meanwhile, the long-term pressures from the ageing population and other health costs have not gone away. Against this backdrop, the government must decide how to balance the priorities of today with the need to invest in fiscal space to confront the shocks of tomorrow. One final thought of what I assume will be my final appearance before you as chairman of the OBR. More now than ever, it's important to value institutions that can give investors and citizens confidence in good government and good economic management. A non-partisan civil service, an independent central bank, robust regulatory agencies, and a fiscal watchdog empowered to serve the public and Parliament by keeping a relentlessly beady eye on how the government taxes, spends, borrows and lends billions of pounds of other people's money. That confidence is hard to build and all too easy to erode. Thank you very much indeed. I'm now going to ask my colleagues to unmute themselves, and then hopefully we can start dealing with some of your questions. Okay, first question I have here is from Ben at The Independent. How much more pessimistic would you say that the current central scenario is from the April reference scenario? What's the dominant driver of the change between the two? Well, the April reference scenario is pretty similar to the upside scenario here. So the assumption then was essentially that you had a rapid bounce back, a V-shaped recovery. So the two key differences in the central scenario from the reference scenario is that you assume a slower pace of recovery, and that you also assume that there is some permanent scarring. So in the reference scenario and in the upside scenario, you basically get back to the March path of GDP, and that's you've not been shunted onto a lower path. In the central scenario, we assume that you end up at a path that's 3% lower, and in the downside scenario, 6% lower. In terms of the persistence of the peak to trough decline, and in other words, how quickly you get to that sort of steady state level, we assumed obviously a straightforward bounce back in the reference scenario. Here we're taking into account the fact that the government is in the process of lifting the restrictions, but we don't yet know how quickly individuals and businesses are going to respond to that. So assuming some greater degree of inertia seems appropriate. And the downside scenario is pretty much symmetric to the upside scenario in terms of the difference between the two. So we have a 6% of GDP hit in the long term.
Robert, shall I just?
Yes, Charlie.
Yeah, shall I just come in to add one other thing that might be useful to Ben in thinking how much worse the central scenario is than our upside scenario, which, as Robert said, you can think of as essentially an updated version of our reference scenario that takes on board the data about the extent of the downturn and so forth. But one way to summarize the extent of the hit over the scenario is to look at cumulative output lost relative to GDP over the 5 years of the scenario. So in the upside scenario, that hit is 2%. So think of that as like the base hit. In the central scenario, that hit is 6%. So that's the cumulative output loss divided by cumulative GDP over the 5 years. And then in the downside scenario, the corresponding figure is 10%, which is of the same order as the hit to the economy in the 5 years after the financial crisis.
Great, thank you very much. Next question from Jeff. Would stronger government consumption and investment speed up and strengthen the recovery and improve the immediate outlook? Well, as we saw, which unfortunately we haven't had chance to encapsulate in the scenario projections themselves, but we put some numbers on the press release and I mentioned them earlier on. You did obviously last week have an additional near-term stimulus, which has got some element of investment in it, but obviously more other things. That is about, you know, the Treasury said up to something like 60 and a bit. I think we think it's closer to 50. You know, we assume on that basis that if you were to run our normal multipliers, of which I know Jeff is a particular fan, through those, then you would indeed see more economic activity, and we'll be doing this in a normal forecast. You would have an indirect effect of that coming back through tax receipts as well. I think obviously there's a question mark in particular, as there always is, about announced increases in capital investment spending and infrastructure and spending in particular, which is actually, you know, whether you can, you know, get shovels in the ground and money out of the door as quickly as you hope you can. So that's probably something to have in the back of your mind for that. I don't know whether, Andy, do you want to add anything to that, or Charlie?
Not from me.
I will just add an extra complication in the current context in assessing how much spare capacity there is, the output gap, if you like. Whereas, I mean, clearly there's an argument for lots of government consumption and investment spending if demand is well short of supply. The problem with the current shock, the pandemic, is or rather the lockdown measures that have been introduced to combat it, have reduced both supply and demand, and by different amounts in different markets. And as the lockdown measures are gradually eased, so supply and demand will potentially recover at different rates across those different markets. So it's, I think at the current juncture, particularly problematic in trying to assess how much scope there is for stimulatory aggregate demand policies, whether it's fiscal policy or monetary policy, to boost activity without potentially generating inflation. Now, it may become clearer as we go through this year where the demand is lagging the recovery and supply, but I think at this juncture it's very difficult to make that call.
Thank you, Charlie. Question from Ed Conway, which is in two parts, and Charlie, I might ask you to answer the second part of it. It is, can you say a bit about how long it takes to get back to pre-crisis peak in this episode versus 2008? versus in absolute and per capita terms. And given it's been a long time since we've had a jobs recession like this, is there anything you could say about how that experience might differ from 2008? Well, in terms of when you get back to the pre-crisis peak in this episode, if you have the document accessible on a screen, the bullet points on page 5 give you the dates at which you return to the pre-crisis peak in the scenarios, which are first quarter of 21, fourth quarter of 22 and third quarter of 24 respectively. Unless anybody waves at me or has a very good memory, I can't remember exactly what the latest data show about how long it took back after 2008, but I'm sure somebody could dig that out. Charlie, do you fancy saying anything on the general, jobs recession and the mix? It's clearly the mix of hours, productivity, employment is a moving target here, and one which is differing from last time.
Yeah, the first thing to be said is about the hit in the short run has been very much taken in hours worked, not so much in employment, essentially because of the furlough scheme. As Robert mentioned, actually we have productivity rising in the very short run because of the compositional effect of the shock, as well as the fact that the furlough scheme has been associated with mainly lower paid and lower productivity workers being laid off. So that's a short run impact, but obviously as the furlough scheme comes to an end, then the underlying picture starts revealing itself, and that will involve a rise in unemployment, productivity dropping back to where it would otherwise be as some of the furloughed workers go back to work and so forth. So the short-term pattern through this year will actually look a bit odd. But then if you're looking further ahead, and I think your question is probably focused more on this, and in particular comparing with 2008. The 2008 downturn, of course, was unusual because it was after a financial crisis when banks had to get their balance sheets back in order and so forth. We saw a lot of wage moderation on the part of workers, which enabled them to keep in jobs and also facilitated reasonably strong employment growth in subsequent years, despite the fact that the overall growth in the economy was quite weak for some years. This time round, I think it's you wouldn't want to immediately leap to saying it'll be the same as last time, because at least certainly in our central and downside scenarios, we think there's a degree of restructuring that will be required. Some say retail businesses no longer having a viable model, and hospitality sector and so forth. So structural change taking place, and that may imply longer periods in unemployment while workers transfer from those sectors which are contracting to those which are taking their place. And that was something which wasn't so obvious after the financial crisis. But here, of course, a lot depends on what happens with the pandemic itself. So if there's an early resolution of the medical issues, then there, as we have in our upside scenario, you may need relatively little restructuring of the economy. But living with COVID-19 for many years without effective treatments may require a much more fundamental change in the way the economy works, and correspondingly more restructuring of where employment is.
Thank you very much, Charlie. Next question from Russ at the Telegraph. What could the potential triggers for rising debt interest costs be? Well, we point out in the report that we're now more vulnerable to both interest rate and inflation surprises. Obviously, part of the debt burden is index linked, and so surprises on RPI inflation can have effect there. That's more important over the longer term, the question of the interest rates at which the government can borrow. I mean, you've seen those being declining and for quite some time, and you know, most people have been surprised by the fact that it's managed to continue going down. There's obviously been a lot of discussion around secular stagnation, which we've talked about before in terms of the various explanations in the long term. I guess two things one could highlight. One, as we mentioned in the book, is, you know, given the consequences of the crisis in terms of, you know, the global increase in both public and private sector debt, that could be the sort of thing that, you know, you would expect to put upward pressure on the natural rate of interest and therefore the rates of interest at which governments can borrow. And the other thing is, you know, it's very important that investors have confidence in the overall framework for economic policy making and the institutions and independent institutions and the other institutions of good government and good management of the economy. So people are confident that the Bank of England is genuinely independent and able to do the job that it's being tasked to do. Confident that you know, the government is committed to and willing to submit itself to detailed scrutiny and full transparency of the really very unprecedented measures that are being taken on the fiscal policy side as well. You know, the DMO continuing to be able to do a good job as well. So I think those sort of broader economic issues, but also institutional confidence are both important. Charlie, is there anything you'd like to add on?
No, I think you've summarised the key points pretty well. So there's two elements to this. There's the first, what happens to the underlying natural rate of interest, which has been drifting down for 30 years for reasons that we don't fully understand. Although there are some of the forces that may be relevant, in particular demographics, where you've had a bulge of middle-aged people who are doing high saving now passing into retirement, and they'll be starting to dissave. So that's one underlying force which is slowly reversing direction. But on top of that, you have the extra issuance of public and private debt as a result globally, as a result of the pandemic. And that's also something which will tend to put upward pressure on the underlying neutral real interest rate. Then on top of that, there's a separate issue, which, if you like, is the risk premium connected with the interest rate that people lending to the government expect. And that's crucially tied up with the credibility of the policy framework, the government's commitment to sustainable public finances over the medium and long term, and the commitment to maintain low inflation. Clearly, if there's expectations of higher inflation, then that would prompt a rise in nominal interest rates to compensate.
Thank you very much. A slightly related question from David Robinson. Given the uncertainty we've talked about around the neutral interest rate and how that matters for debt interest, what assumptions should policymakers make about it? Should they factor it in as a downside risk, etc.? Well, I think one of the lessons of this report and of the fiscal risks report we've put before is that it's important for governments to think about the range of possible outcomes that you could end up with in terms of that factor, and have as good a sense as you can of exactly how quantitatively that's significant those sorts of surprises would be, which is one of the reasons why we found the sort of the stress testing process in the fiscal risks report to be useful, and trying to use scenario stuff as well. So it is then you come to this judgment about how much comfort room do you want to give yourself, how much fiscal space, how much do you want to invest in fiscal space to deal with not only the shocks that can come across in terms of shocks to the economy, but shocks to borrowing costs as well. So being alert to how significant it would be if it varies by X or Y from the central path is an important input into that decision making. Charlie, again, anything you'd like to add on that?
Hope for the best, prepare for the worst is always a good maxim.
Very good, very succinct. But hold on. Anna at the Telegraph. You say tax rises or spending cuts are likely to keep finances sustainable. When do you expect this to start, and how much more revenue would need to be raised this way? Well, the fact that we've pointed out that over the long term, the public finances are on an unsustainable path, in the sense that, given the assumptions we make about long-term policy in terms of public expenditure and the path of receipts, you would see the debt to GDP ratio rising over time, is not new to this report. That's been a feature of every fiscal sustainability report that we've produced, implying the need for some policy action at some point. The current crisis, means that you start from a less favourable baseline at the end of the medium-term period, but still highly uncertain as to how much difference this crisis is going to make to that jumping-off point. So the decisions on when policymakers feel confident enough about how the public finances are going to be looking coming out of this, and therefore when you put in place those policy decisions, is a matter for them. But as I say, certainly consistent with what we have said before, the idea that there are long-standing fiscal pressures that are going to have to be addressed at some point is there. In the way that we calibrate the size of the adjustment that might be needed, we make the point, obviously, if you're dealing with a multi-decade trajectory, you don't have to do what some of the academic exercises use for illustration, which is make a one-off adjustment straight away, and you can obviously do that over a longer period as well. But this combination of waiting to see how big the scarring is on the economy and therefore on the public finances, waiting to see what the other pressures are on spending on things like health and social care, which of the temporary support measures end up not being temporary. As I said, at the moment, the debt interest dog is not barking particularly loudly, but being alert to that. So all of those things need to be taken into account in deciding, when and by how much it is sensible to make an adjustment later on. Anything that Charlie or Andy would like to add to that?
I would just add that the numbers that we show in the report for the kind of decade by decade tightening, so I think 3% of GDP in the central scenario, that's less than half the consolidation that took place after the financial crisis, and that's to address slowly building long-term pressures as well as the scarring from this event. And the reason it's lower is essentially because the scarring from the financial crisis relative to pre-crisis expectations was just so much larger.
Charlie, anything you want to add?
No, that's fine.
Okay. Right, where are we? Phil, you mentioned that debt will need to fall more quickly in good times to build fiscal space. Will there need to be operating fiscal surpluses in these good times to ensure fiscal sustainability? Well, it's going to be for the governments to decide or to design the fiscal rules and what it wants to do there. This will be tied up in part about the sort of the prospective deficit, structural deficit that you're ending up with in the medium term, but also the degree of danger and how much comfort you want to give yourself against an unfavourable movement in the government borrowing costs relative to economic growth. But the general principle has been normally that, if you have a rise in the debt to GDP ratio in the face of the shock, you don't necessarily try to bring that down hugely quickly, but you don't want to be in a situation where it just ratchets higher and higher and higher with every crisis that comes along, because at some point that's going to leave you in a position where you are very vulnerable to having to make a very big policy adjustment. And what we saw in the wake of the financial crisis is obviously a lengthy period of fiscal consolidation, which even, after the 5, 6, 7 years in, had only just been enough to stop the debt to GDP ratio rising. And we've now had another crisis pushing it further above that. I think we're all familiar with the fact that attempts to identify a particular debt to GDP ratio at which, you know, slightly above it is a disaster, slightly below it is fine, has not been terribly successful. But clearly you would be worried about a situation in which the debt to GDP ratio just rises systematically, shock by shock, and that you do therefore need to have, you know, some efforts to invest in some fiscal space there. Charlie, anything you'd like to add on that?
No, I think that's fine, as long as you basically aim to be bringing the debt to GDP ratio down, possibly at quite a gentle pace during the good times. That will mean you're building up fiscal space for the next time there's a bad shock that comes along. But clearly, the more slowly you do it, the more risks that you run that a bad shock may come along before you've built that fiscal space up. But that's essentially a balance of risks that politicians have to take, not us.
Thank you very much. Sue, I think Andy may have answered this question for you while you were writing it. You sketch out the austerity need to return debt to 75. How does that compare with what we've already seen? And I think Andy was saying that the sort of adjustments that are implied in that exercise are considerably smaller than that which we saw in the wake of the financial crisis. I don't know whether he's going to want to add anything to that. Let me get to the end of your question. Is living with higher debt shares an option? Well, you know, clearly the government took the decision has taken the decision over the last couple of years that it was, you know, no longer saw it necessary to have the debt to GDP ratio falling significantly and the budget balanced, and therefore moved away from that, although it's actually still still a legislative fiscal objective to get the budget back to balance in the mid-2020s. But by the March budget, the government had said, look, we're more content with leaving debt roughly where it is as a share of GDP and to run a deficit year in, year out, not to balance the budget because borrowing costs are relatively low. But clearly the question is whether you you know, whether you're still content to do that in the wake of this crisis as well. Andy, is there anything else you want to add on relative size of fiscal adjustments? Or I think you answered the question, but
just to add one thing on the, you know, what is realistic. I think, you know, our long-term projections basically sketch out choices for future governments between reducing the volume of health services on a age-adjusted basis, which history suggests hasn't happened, and raising taxes to a tax to GDP ratio that, you know, political economy in the UK has not delivered in the past. So how realistic is it is probably not for us to say, but difficult is certainly true.
Thanks very much. Tim at The Telegraph, is the government taking the scrutiny seriously? You've given some warnings today, and its response to last year's report is only 4 paragraphs long. I think, you know, obviously the year before was a very substantive response to the fiscal risks report. You know, much of it's championed by my illustrious successor in this role, Richard Hughes, when he was at the Treasury. This one is obviously very brief. I think we have to cut the government or the Treasury a bit of slack on the grounds that they have got a lot of other things on the plate at the moment, and are obviously very focused on the immediate policy challenges of the coronavirus, and, you know, when we get to the autumn, more of the medium-term settings as well. But I would certainly, I think that the government did a very interesting thing when they put in place and indeed into legislation the fact that we should write the fiscal risks report, and then that the government is formally required in legislation to respond to it a year later, set up a very interesting, and by the standards of other, you know, countries, an unusually powerful conversation between government and us that hopefully would drive more serious consideration of this. So I certainly hope that well, it will be after my time, but that I shall read that there's been a slightly larger than 4 paragraph response to the 2021 fiscal risks report. Next one from Unidentified caller. What is your assessment of the furlough scheme? It looks like the vast majority of workers get their jobs back, yet unemployment still rises to extraordinary levels. Charlie, would you like to have a crack at that?
Sure. Well, I guess the first thing to remember is just the sheer scale of the furlough scheme and the support for the self-employed, where you've got getting on for a third of the workforce essentially being temporarily supported by the state because their employer has not been able to operate in a normal way. So we do assume that the primary aim of the scheme, which is to bridge across the period of lockdown and minimise the destruction to the economy's supply capacity by avoiding unnecessary business failures, basically the furlough scheme delivers. But that doesn't obviate the fact that some of the jobs just disappear. Now, we've made an assumption for each of the scenarios that 10% in the upside, 15% in the central, 20% in the downside, those share of furloughed workers go into unemployment rather than back to their jobs. Now, whether that turns out to be a good estimate or not, it's informed by what businesses have been reporting to the likes of the ONS in their high frequency indicator survey and the bank's decision maker panel as well. On top of that, I think it's worth saying that probably this event has accelerated some job losses which would have happened anyway. There's always churn and job losses in economies, and when you have a very big event, it may force businesses to act more swiftly than they otherwise would have done. So a mix of necessary structural change and bringing forward job losses which would have otherwise maybe have taken place a bit later on helps to explain why we still get a pretty significant rise in unemployment, even in the upside scenario where there's quite a strong bounce back. Although in that scenario, the rise in unemployment is relatively short-lived, whereas in our central and downside scenarios, which have much more structural change taking place, unemployment remains elevated for considerably longer.
Thanks very much. We've detained you for more than an hour now, so I just wonder, before we finish, Andy, is there anything else you'd like to add on terms of the way in which the furlough scheme has operated and what we've learnt about that from the data as time's gone by?
Well, just to confirm that the data from the scheme that we're looking at does show what the surveys are saying, that use is very concentrated among those on lower than average pay, and is sectorally concentrated. So it just reinforces the message that the restructuring that is likely, but we don't know the scale of it, the furlough scheme is very much intertwined in that.
Great. Well, thank you very much. As I say, we've detained you for more than an hour now. I hope that as consumers, you've managed to hear what we're saying. I haven't been shouting into the void for an hour, but thank you very much indeed for participating, for getting in touch. The slides and the speaking notes should now be available on our website if you want to get hold of those. And it just remains for me to say thank you very much indeed, and happy reading if you haven't managed to read it all already. Thank you very much.